cheaper. There may be a constraint issue, supply issues, price. It may be counterintuitive today, but maybe it makes more sense to have your home heated with electricity. And then there's a whole series of lifestyle choices. Are you going to have a cabin 100 miles from your home? Are you going to have a condo in Hawaii and a home in LA? Are you ever going to go to your condo at Whistler if you live in Seattle ever again, even if they do have the Olympics there? And then there's this whole series, and I want to thank my son for this. He reminded me that of all the talks I give and all the feedback I get, I'd managed to leave this out initially. And it's the whole community risk. If your community doesn't understand the implications on public health, on transportation, you could get all those other things absolutely right and get completely blown off the deck by that one. And that's why it's important that not only we think in terms of investment ideas, but we got to be proactive within the community because it matters. You could get everything else I'm going to talk about right, and if they get that wrong, you could still be toast. Now, the traditional stuff, and most of us here already know this. I mean, you're going to want to own some oil guys. And then you got, I can hit the buttons, right? You got gas and coal and nuclear and hydro. And there's the traditional, and that's the first place almost everybody goes, is to look at those. But then you've got wind and solar, but we don't know who the winners are going to be, and I'm going to let Jim, the other Jim, will speak more specifically to that and how you look at the alternative energies. And then you've got these other areas which are going to be tremendous impact areas, and this is more where the opportunities are going to lie. And one good example is rail. I mean, we're going to electrify and move to more and more rail. But we got to double track a lot of rail in this country. Out in the Northwest in Seattle, we got a single track tunnel through the Cascades that's 7 miles long. It is a major bottleneck. They cannot run any more trains through that bottleneck. Well, the implication is we're going to maybe have to take back one of the currently closed rail lines across a pass, which is currently a bicycle trail. Well, now the public's going to have to look at this and value it differently. There's going to be a public policy change. They're going to take that rail back. Ironically, it's an old Milwaukee line, which was fully electrified. And speaking of electrification, transportation system, and you've got a number of people that are going to speak to this, I'm sure, over the course of the next few days, but we electrify the transportation system, and within that, there's tremendous opportunities. And then there's the infrastructure. But now in infrastructure, you've got to be really careful, because in a moment, I'm going to put infrastructure idea up on the avoid column. A blanket shot at infrastructure, you can get very, very wrong if it happens to be a toll road in which car usage is going to decline. And then there's technology. Now, being from Seattle, of course, we're convinced in that town that technology will make it work for us. Technology is going to save us every time out. I mean, look what it did with Microsoft. It saved us from the shrinkage of Boeing, for example. Well, maybe, maybe not, but it's a great opportunity area. And then in the avoid area, by avoiding the airlines in the last 12 to 18 months, you did pretty well. Now, there's a little bounce off the oil price move, but I don't think one want to get suckered into that potential black hole. Trucking, I have a few clients who work for trucking companies. I've recommended they look for a job with Burlington Northern. I mean, that's one of those personal energy kind of career choices, because if you're driving a long-haul truck, you're now competing against the railroads. And then there's this issue of globalization. I'll talk a little bit more about that later. And then there's discretionary spending, and I know Jim is going to comment a little bit on that, and I know Dick has some observations about lifestyle that he makes. But that's a big area. And then there's this issue of debt. Now, most of us are thinking about real estate debt, Fannie Mae, and all of those kinds of debt. But keep in mind, and if you were at the conference last year, Roger Bezdek made a very, very good argument that you need to pay real close attention to the funding source behind your bonds. If you've got an airport bond, and it's backed by landing fees, and the number of flights is going to be cut because the airlines don't have the customers to fill the seats, you may have a problem there. And if you're invested in a mutual fund that holds those portfolios, you might want to pay attention to that. There's a whole series of places that that's an issue. Is your community going to fund, and in Seattle we're looking at a couple of major highway funding deals, and it's going to maybe decide the governor's race in Washington is a highway funding. And do I want my kids and grandkids to be paying for roads in Seattle? They're going to find less and less usage. And by the time that I'm gone, they're still writing checks to cover that useless project. Some of you probably saw this. There was an article in Forbes, which is the first part, and then the latter portion is taken from Hamilton's paper. But I think from an oil investor's or peak oil aware investor's standpoint, it's very important to be aware of price risk. And that is that the price swings in the short run could undo your best ideas. You could get suckered into a wrong call. And I think a good example is, remember where oil at this week was as low as 90 and it closed out at 104. We'll talk about a round trip swing if you were betting the wrong side of it. And so Hamilton's work showed interesting that you got a standard deviation during a quarter of 15.25% roughly. That's a huge swing in just 3 months. So you could get completely faked out. And then the other is he makes a point in his paper about scarcity rent or a scarcity premium on petroleum or any energy. There is none in the investment environment. The people I talk to who run mutual funds or investment pools or other brokers or other advisors, they do not put a scarcity premium on energy, whether it's petroleum, coal, gas, electricity. There's no scarcity premium in the market. Now this is the 10-year chart of price. I tried to keep it as current as I could. It actually goes, the data actually takes it through a week ago, prior to our really goofy week. There's our infamous $10 low that year. I know Steve Andrews likes to remind me that the average that year was $17.50, and to not get too focused on the 10, but it is a nice number. But here's a 32% decline. I imagine most of you in the room didn't even remember it. The American public sure didn't. Here we have a 35% decline. And the decline off the $147 peak at a little over $100 was a 31% decline. So the decline we've experienced here is totally within the realm of normal. Here we had a 47% decline. So again, it's just kind of re-emphasizing that I think you have to be really careful not to get your eye off the ball if you're focusing on price too much. How many remember that one? 215% move on the upside. Now there you want to be levered, right? No. Here was 130. But I think maybe up here at the top, to kind of put it in perspective a little easier, would be to think in terms of a little lower high. I mean, what really kicked us over into that 140 plus number may have been short covering by some hedge guys who really thought oil was going to go down. Remember, they believed it was going to go to $60. Majority of the investment community doesn't believe we have a problem. So they're going to, when you get up in those numbers, they're going to want to go on the short side. So if you kind of move from there, that puts the 31 or 30% decline down into the mid-80s. So if we go to $84 oil, it's totally within the realm of those numbers, those 30% decline numbers. So don't get pulled away from your understanding of peak oil and gas by these price swings. They're totally normal. Another thing is, a lot of the folks I deal with, they get these two things confused. They're not exclusive, but if you focus on the green, you may completely miss the energy side. And if you focus on the energy side, you may completely miss the green side. And that's one of the risks we have with a policy that's based on emissions, which is you know, if you looked at our current presidential candidates' policies, they're emissions policies mostly. So you got to be a little careful of that. Don't get maybe your environmental or green enthusiasm, get your eye off the ball on the whole energy idea. And then this comes back to my central theme. How does peak oil fit into the whole picture of your investments? If your investment idea can't pass that screen, then move on. Unless you're a short-term trader, and I know there are some people who are short-term traders and like to trade with short-term, but if you're that way, then make sure you are honest with yourself about it. But if you go into this thing as a long-term investor, then make sure you keep your focus on the strategy. Why you bought something probably will tell you when to sell it. It's your best indicator of that. And if you're using leverage, you know, be careful that that leverage doesn't force you to undo your very best idea. I've seen that way too many times. They've been absolutely right, and leverage has blown them out of the positions. And then this is actually from a fellow named Jean-Marie Evelard, who for years has run the Sojin International Fund, where the First Eagles it is today. He's a very, very bright guy, spectacular performance record. But this is the first question that Jean-Marie always asks on an investment. Most people want to know how much they can make. If you know this or have a grip on this, then you can value how much that other question is worth. So I would suggest put this at the top of your list. All right, ETFs are hot and popular. This is one of the most popular energies. And the point I want to make here, and this is similar to the one I made in Houston, if you buy this and this is all you own, as you can see, you have a very large chunk of your money in one company for sure, and 5 dominate the scene. And the other thing is they're all US. This is totally a US oil fund. And there's no coal. Over half the electricity in this country is coal. 80% of China's primary energy is coal, and it's not even represented here. So the point is, again, there's no nuclear, no renewables. So this is not a portfolio. And then on the alternative side, this is one of the popular ones. The wind is the first and third. Solar is predominates the rest of it. There's a small position in geothermal through ORMAT, and there's no wave or ocean tidal exposure at all. So again, if this is a relatively small portfolio, this might be your only green exposure if that's something, or your alternatives if that's something you're looking for. But as you grow, you may want to take a serious look at that. I am a real big fan of geothermal. And now, the areas to watch, the picture at the Volt, and by the way, that is the one that they're going to use. That's the real thing. Of course, I got a picture from the back end. Anyway, but that's going to be a commodity, and it's going to be very sensitive to the lithium input, the labor costs, and all the other. I see the greatest opportunities in those two extension cords and all the things that are hooked to them. That's because without those, alternative energies do you no good at all. You can have all the wind turbines in the world, but if you can't get the power to where it's needed, it's useless. And it's a more conservative way to be invested in it. That's my take on that. On the rail side, you know, everybody's all excited about the trains, and Warren Buffett owns them, and as soon as it comes out that he owns a position, of course, they move, and then a lot of you probably know that Bill Gates' largest position in his personal account is Canadian National. But below that, there's all kinds of other stuff, because if there's no rail, those trains don't run. So who's producing the rail? Who's doing the friction management of the wheels? It's a very interesting area to look. What about the brakes, the bearings, the lubricants, the whole mix of the infrastructure that supports that train? So maybe the high-profile, high-price product might be on the trains, but dig deeper than that. Take the knowledge of peak oil and put it to work for you. Go deeper. And then finally, what other great ideas? And I'll tell you, every person in this room knows something that could fill in that question mark on the right. There's an area that you know that majority of us either aren't aware of or don't know about because it hasn't come to us yet. That's your edge. That's your advantage. And then there's this. Now, those of you who are in Houston know that I made the comment that Boeing would never deliver half of the 787s that have been ordered. Subsequent to that, I've been told a number of times that my number is too low. I don't want to pick on Boeing, so I'll add the A380 to it. If you get the Financial Times, or if you go to the Financial Times website at ft.com/A380, you can see a video of the Emirates A380 that's currently flying with the cabin in it with a shower and the business seats. Those things are doomed. That A380 has to lift a tremendous amount of fuel just to lift the fuel that it's going to use. So the airline industries are going to change. I like to tell folks that we're going to go back to the 1940s and 1950s, and Clark Gable will fly and I will ride the train. And then below, you have below that is actually, if any of you from Washington, California know that in Oregon you can run these triple trailer rigs, that's an experience passing one of those, by the way, on the freeway, because it takes an hour. But that is a stopgap measure. It's a dead end. The trucking industry is too energy intensive for long-haul trucking. But the impacts on communities that depend on that long-haul trucking, because they've killed off the rail or they've killed off the other forms of, rail would be the only one, but the only way they get their materials, some of these communities could be under stress. Lower right-hand corner, because the whole automobile industry there are opportunities in there, but for the life of me, I can't figure out where they are. Jeff Rubens, who I understand are going to have a remote with him, a pre-done position. Jeff gets it, and he, in one of his pieces earlier this year, commented that he thinks that the U.S. car fleet will start shrinking at 10 million units per year. Well, if we shrink at 10 million units per year, one, you don't want to own a manufacturer of cars unless it happens to be the only one people want to buy. But it also says that the revenues based on the use of those cars, gas taxes, tolls, are going to contract. And then finally, in the upper right-hand corner, and this is, I think, the one that right now most people don't, and I'm not sure I've got my head completely around this one myself, is that globalization is going to unwind. It is toast. Again, to go back to Jeff Rubin, he did an analysis of steel He thinks that in the area of steel, transportation costs become a tariff on foreign imports. And in fact, right now, it's cheaper to bring steel in from Pittsburgh than it is from China because you only have 1 man-hour of labor in a ton of steel. And it's very easy to overwhelm that 1 hour advantage. 1 hour of man labor is just not enough. So I think we're at the bottom of that incident. We're going to see it in things like steel and raw materials that have high transportation costs and low value added. But over time, as transportation costs rise, that's going to move its way up the food chain. And eventually it will get to Nike shoes and T-shirts and some of these other things. This also was in the Seattle Times. I don't think it was done by one of theirs, but again, being from Seattle, the belief that technology is going to save our bacon, and I think it's very unlikely that, in fact, technology will pull our chestnuts out on this one. And so don't overweight that in your approach to working on the peak oil investment scenario. It is important, but we have a very, very high level of faith in technology in this country. And it's going to come down to how far you can walk, maybe. No, I'm not that cynical. We're not going back to the 1400s, to quote Roger Besdeck. My favorite quote, this is on all my emails, and I think most of my family is sick and tired of seeing it. It's difficult to get a man to understand something if his lifestyle, religion, job, whatever, depends on him not understanding it. Make sure you also apply that to your own thinking. Don't go over the top on peak oil to the point that you are unable to understand alternatives either. And then finally, Chief Sealth, whom Seattle is named after, made this statement. We did not inherit the earth from our parents, and we are borrowing it from our children. My father told me very early in my life that if I borrowed a saw from somebody, I was to return it sharpened, better shape than I borrowed it. Well, I would like to believe that what we're going to borrow and give back to our kids will be better than what we currently have in our hands. On that note, if any of you are interested, I do put out a weekly piece. You can get a hold of me. You don't have to copy that down. But again, I enjoy input because it's the only way that I can be questioned as to what I think. So thank you very much, and I hope you found something valuable from it. Yeah?
Thank you, Jim Hansen. Our next speaker is Jim Puplava, who's from San Diego. And his business experience includes contributing as a financial writer to various publications. He's a TV business editor, and in 1988, Jim began hosting Financial Sense Talk Radio on various stations in San Diego. And he oversees portfolio management team at Puplava Financial Services and Puplava Securities. And he continues his weekly broadcasts and thought-provoking commentary for Financial Sense Online. Please join me in welcoming Jim Puplava.
This is kind of funny for me. Going back 10 years ago, I would have never thought I'd be sitting in front of a room speaking at an ASPO conference. 10 years ago, I picked up a book called The Coming Oil Crisis by Colin J. Campbell. I read that, and I didn't think I slept that night. I was having nightmares. And then, of course, oil prices dropped down to $10 a barrel, and I said, whew, dodge that one. And here we are 10 years later. When I was asked to come up here and speak, I was talking to Steve Andrews, and I said, we are living in historic times. What we've seen occur here in the last 3 weeks, what's occurring this weekend, and what we are going to see in the next week are truly historic. You would have to go back probably 70 to 80 years to see what's unfolding in the last 3 or 4 weeks. So I'm going to be talking about some of the economic, broader macro themes of this. I'm not a geologist, not a scientist, but I look at this from an economic point of view because when you look at the economic environment, we tend to believe in long-term investment themes. A lot of these things develop, if you look at cycles in the market, they tend to go over an 18, 20-year period in the economy. And it has a lot to do with supply and demand. But when I take a look at the crisis that we're all focused on today, the credit crisis, the one good thing about a credit crisis in a paper society, you can create money out of thin air, and you can paper over the crisis. But what I fear is the greatest crisis facing us is the peak oil crisis that's going to be approaching in the next decade. And unlike the Federal Reserve can create paper money out of thin air. They can't create barrels of oil, new power plants, or energy. And so what I'd like to do is take a look at some of these broader themes. Okay, there we go. That are going to be developing. One is the death of the consumption society. As many of you know, today consumption drives a bulk of GDP. Jim alluded to it earlier, and Jeff Rubin will be talking about it, I'm sure, tomorrow, reverse globalization. And then when it comes to investments, the guerrilla game. How is this all going to play out? What technology companies, what energy companies, what alternatives are going to come to play in the marketplace? And then finally, the big unknown. How does all of this play out over the next 10 years, the next couple of decades? Will we solve it peacefully? Will we find a solution? Will there be a magic bullet? And we'll get to those in just a minute. But I want to talk about the consumption society. Believe it or not, at one time in the United States, we used to save between 10 and 12% of our income. Oops. There we go. So you can see there, going back over the last 3 or 4 decades, savings peaked out at roughly about 12%. And you can see over the last 3 decades, you can see that decline. What has caused it? Well, a number of things. Rising taxes, inflation, increasing debt levels, all of that has played into the savings and consumption environment. If we take a look at the one thing that worked out for most consumers in the 90s, as our savings rate went down, as our rate of consumption went up, well, we would put it on credit cards. You'd run your credit cards up to the maximum, and then what you do is you got a line of credit on your home. You paid off your credit cards, cleaned, wiped the slate to zero. Interest rates were coming down. The value of your house was going up, and this worked beautifully up until about 2 years ago. So you can see there, when they talk about the consumption society, you can just see the amount of equity withdrawal from homes, and then correspondingly, the amount of equity that we have in our homes. And even there, it's below 50%. That is distorted because a lot of people that are retired, a lot of people that have wealth, have homes that they own free and clear. But overall, you can see that we've been using our homes as ATM machines. There's, for most average Americans, the largest tax many Americans pay is Social Security. And there you have the wage base, and you can just see, even though individuals have seen their pay go up over the last 2 or 3 decades, the amount of money that is subject to Social Security taxes has gone up every single decade. And there's talk about removing the caps of Social Security, and as many of you know, over 102,000, you're subject to the Medicare tax. David Walker, who was comptroller of the currency, made an interesting report last year, and in the current issue of Forbes, a gentleman by the name of Lawrence Kotlikoff is talking about who will bail out the government. And he said by the year 2017, there's going to be 78 million baby boomers in the United States that are going to be on Social Security and Medicare at an annual cost of $50,000 a year per person. That's $4 trillion. Last summer, David Walker, who used to be the comptroller of the currency, chief accountant in the United States, said that we need to do 2 things. He had 2 scenarios. The best case scenario, our politicians in Washington would start addressing the issue immediately. The worst case scenario would be they would postpone it to some other political election into the next decade. The best case scenario, he said, we would have to raise income taxes 44% and reduce government spending by 20%. Now imagine if I'm Barack Obama or John McCain and I'm running for office and saying that I'm going to raise your taxes 44% and cut spending 20%. Now that was the optimistic scenario. The next scenario was if we did nothing and leave the problem or left the problem to the next decade, we would need to raise taxes 88% and reduce government spending 40%. And if we didn't do that, there was a third option, hyperinflate. And I would submit to you that the way things are going in Washington with the budgets, the bailouts, hyperinflation is down the road. What is interesting, if you look at the U.S. economy, we were mainly around 60% with investment, government spending, and you could see as the savings rate went down, as consumption went up, as debt levels went up, you can just see there the driver of personal consumption as a percentage of GDP. Today it's over 70%. And if you take a look at, here is a rather disturbing trend and dissect the components of GDP. Here has been our exports. The one good thing about our economy right now is exports have gone up. Here is consumption as a greater percentage of our economy. Here's investment, which has been in a very narrow trading band and is on a decline, and there are government expenditures. This is what we're going to have to address in this next decade, and especially when we look at the energy sector. You know, it's rather interesting. Both of my parents were Europeans. My parents were born in Europe, and I'm first generation American. I didn't even speak English until I was 6 years old. And I thought about when my parents got married in our first home. We moved to Phoenix, Arizona from Hammond, Indiana. My grandfather worked for John D. Rockefeller in the refineries. And what has it meant to be middle class in the United States? Our first home was a 3-bedroom house with a living room, and we actually lived in the living room. We had one black and white television. We had a carport that contained one car, and there was a laundry room off the side of the carport with a washboard. And that was middle class, 1,100 square feet. Fast forward 3 or 4 decades later, we have McMansions, 4-bedroom, 5-bedroom homes, 3,000, 4,000, 5,000. I live in a neighborhood where one of the biggest homes is 40,000 square feet. Instead of one-car carport, we have 4-car garages. We have media rooms. We have family rooms. We have studies. All of that requires a lot of energy. As I got into peak oil and learned more about it, we came up with a concept that we call live, work, and play. I am from the grocery store, from my home to the office, either 5 minutes by a bicycle or car, or 15 to 20 minutes if I had to walk. And I think that's kind of what we're going to see develop in the future. It's not going to be that you live in San Diego and you work in Orange County and you commute back and forth. That's not going to work when oil's at $200, $300, or $400 a barrel. A second concept I'd like to refer to is reverse globalization. My friends at GavCal have come up with the concept that they call the platform company. And if you take a look at American industry over the last 2 or 3 decades, the platform company kind of works like this. They come up with the brand, they design the product, they outsource the manufacturing to other parts of the world, and they do the marketing. And the amazing thing about all that, they make the majority of profits. And so you might have a computer manufacturer, and they may order raw materials from Latin America, send it on a boat to Singapore and Korea where the component parts are made, and then it's shipped to China where it's assembled in a box, and then it takes a 4-week journey from China to Long Beach where it's put on a railroad car or it's put on a truck and shipped. That's not going to work. And it's amazing. There's a group of individuals in San Diego. They make gym equipment. And they are now one of the largest producers of gym equipment in the world. They make the component parts, And about 5 or 6 years ago, they shipped the component parts to China, where it's cheaper to assemble it, put it together, box it, and ship it to other parts of the world. I would submit to you that model is going to work at 200, 300, or wherever we're going with oil. This is from Jeff Rubin's piece earlier in the year, where he talked about transportation costs becoming the tariff on goods shipped. And as you can see here, in the year 2000, a 40-foot container cost $3,000 to ship. Today it's $8,000, and at $200 oil, that's going up to $15,000. So it's cheaper to get your steel here in the United States than it is to get it from China. Here's another dramatic outcome. As you can see there, for the airlines, over the years, labor costs were the largest component for the airline industry. Peaked somewhere around the turn of the century, and then you can see where it's gone down. And you can see for most of this period of time, we were in that $20 to $40, there's the Gulf War. We'd have these spikes, but take a look at the crossover point. Now, as one president of an airline said, we have done everything that we can do to cut our costs without jeopardizing safety, and our largest component of cost is something I have no control over. Well, I can say for the airlines, I hope they're hedging their costs now with oil at $100 a barrel. You can see there the shifting dynamics of international trade. I think manufacturing is going to have to come home, and you're already seeing that with a lot of automobile companies. What I think is you're going to see regional manufacturing. If you have a market and 20% of your business is in Asia, you better have a factory there, because it's not going to work shipping it back and forth as shipping becomes a greater component of trade. Now, Jim referred to and talked about investments. And there was a gentleman by the name of Jeffrey Moore that wrote about how investment cycles and technology cycles are developed. And when a new technology comes on the scene, whether it's the automobile, it's radio, it's the airplane, it's the internet, it's computers, as always with a new opportunity, you see a lot of entrants, a lot of companies that come into it. Because this is a great new idea, you get a lot of companies that are formed. At one time, I think the figure was we had over 200 automobile companies in this country when the automobile was invented. So when a new technology comes on the scene, you don't know who are the gorillas, who are going to be the giants that are going to emerge. And so one of the safest things that you can do is maybe take a shotgun approach and you invest in a broad array of companies, whether it's solar, it's alternative, winds, whatever the technology is. And eventually, as the cycle completes itself, you will have the giants, the gorillas, and the titans that will emerge. You will have the Intels. You will have the Ciscos that will come to the top. And as the cycle develops, you move from that broader approach of investing and you start focusing more and more, fine-tuning on who those up-and-coming giants are going to be. You know, this is something I learned over the years. I've had the privilege of probably interviewing over 70 different authors on peak oil. Every one of them has added a new dimension, a new element. And when you talk to somebody about energy or peak oil today, you'll have somebody say, well, we need alternative energy. We need wind, we need solar, we need to go to clean coal. You know, it's like one of those test questions you got on an exam. They ask you the question, they give you 2 or 3 answers. Well, you know, when it comes to peak oil, it's D or E, whatever happened to E here. All of the above. Somehow that got cropped off. And the other thing that we don't know about how this plays out is the great unknowns. You don't know if it involves military conflicts, as Richard Heinberg has talked about, or Michael Clark has written about in his Resource Wars. Will it be or move back to the dark ages like the long emergency, as James Kunstler has talked about, or will it be Jeremy Diamond's collapse? It is absolutely amazing to see over the last 3 to 4 years, 2 hurricanes hit the Gulf in 2005. 3 years later, 2 other hurricanes. And you would think somewhere along the line we might want to be thinking of having our refineries, whatever they're going to be, outside a weather belt. Maybe put one in the middle of the United States or somewhere where you don't get tornadoes, you don't get hurricanes. And it's amazing as you watch and see this, and nobody seems to get it. Everybody has like one particular answer. And I really don't think there is a silver bullet when it comes to energy. It's like that test question, all of the above. And we need to be doing all of the above. My greatest nightmare is we will see a situation, and I'm going to talk about this tomorrow, where a lot of these variable rate mortgages hit a peak in June of this year. And as many people know, there's a lag period between the time a person defaults on a mortgage to the time the bank takes possession of it until the time it goes into the market. Well, we got two other scenarios here. We have the credit default swaps. You just saw that unfold this week with AIG. And between 2010 and 2012, you have option arms. And that was the bulk of financing done here in 2005 and 2007. And my worst nightmare is all of this hits. We think we're going to get through this crisis. We're going through this bailout that they're working this weekend. They're called weekend huddles. Have you ever noticed? 3 or 4 weeks, you never know what you're going to wake up with when you wake up on Monday morning. My evenings look like this. I'm in my study. I have my TV turned on to Bloomberg Asia to see what's going on over there, to find out what's going to hit us in the morning. I have my portable phone. I'm talking to my hedge fund friends in New York and Hong Kong. And then some will come up with this consensus and they'll say, this is going to happen tomorrow morning. This is going to happen. Oil's going to go up. Oil's going to go down. The market's going to go up. It's going to go down. And you turn on the TV the following morning, and it's the absolute opposite of what everybody was talking about the night before. And it was funny because Tuesday, I was talking to 3 hedge fund managers, and they were firmly convinced when the Fed left interest rates alone and AIG went under that they wanted to go short. I said, guys, beware of the weekend huddle. Something's coming up here. Thank goodness they didn't go short. But you know, it's interesting when we take a look at this. As I said, there's a great unknown. And one of the things I hope we don't evolve into is what Lutz Cleveland has called the new great game. And as you can see there, there's the Middle East, there's the Caspian. Those are pipelines, proposed pipelines, and then the red stars are military bases. I come from San Diego, where we have 3 or 4 carrier battle groups that move into this area. And you can always tell when something's going on when I go sailing and I don't see any ships in the bay. You know trouble's coming. Finally, when historians look back, you don't know how this will play out. Will it be like Shelley looking back at the works of Ozymandias? We simply do not know at this point. Yeah, I just hope that as energy prices go back up, that we will start looking at this seriously in Washington and around this country, because it is certainly going to be a global community. It's not going to affect just us in the United States. It'll affect everybody around the world. And everything is tied to energy, water, food. But I do think we are going back to basics, and as Charlie Maxwell has talked about, in the next decade, life in this country is going to change. Your friends, you will live closer to them, and your vacations will be local. It was absolutely amazing coming up here. I was looking at getting connecting flights, and it was going to be 8 to 9 hours. To fly out of San Diego, I was going to go to Vegas. Couple hours stopover. From Vegas, I was going to go to Sacramento. Flying home, I was going from Sacramento to Phoenix, and from Phoenix back to San Diego. Well, I drove. Thank you very much.
Thank you, Jim. I particularly like the idea of maybe looking at a basket of investments through an exchange-traded fund or a closed-end fund that holds a number of investments in these various arenas, and then carefully watching the components in those baskets to see really where the cream rises to the top, and then moving your concentration towards those. It's a very good suggestion. Our next speaker is Richard Vodra, and I'm going to take my glasses off so I can read. Dick is a JD, CFP, has been a financial planner in Northern Virginia since his graduation from Yale Law School. He's an active member in the Financial Planning Association. He's first vice president with Spire Investments of McLean, Virginia. He's a registered representative with Spire Securities, and his views on energy, as with most things, are not expressions of the opinions of Spire. So with that, would you welcome Dick Vodra? Thanks.
I don't have any slides. How do I get rid of this?
Press escape.
Okay.
You turn it off.
There we go. I don't know that I need that either, so you can look at me either way. The title I had was Something's Coming, Surmises, Surprises, and Scenario Planning. It's good that I don't have slides because everything I know I learned on the way out here reading the papers from the last few days. A lot of what we do in the kind of talk that the Jims just gave are the surmises in which we look at mega project lists and the export land model and try to figure out what's happening with peak oil and some of the other issues, and then what responses can occur, and then what logical kind of investment policy we might come out of that. And then we have surprises, which are the things that we didn't or don't expect to happen. Jim just mentioned that we had 2 hurricanes in 2005 and 2 hurricanes in 2008 of comparable size. One hit, both of them hit Louisiana this year. One hit New Orleans and one hit Houston. In one of them, the price of oil went up, and the other one, the price of oil went down. We've had, in the last 3 months, a war in Georgia, which is the only non-Russian place that has pipelines. We have a war in Nigeria where they've said we're going to try to stop all oil production. And we had 2 huge hurricanes, and the price of oil has dropped by 1/3. Now, something's going on. I don't understand it, but it's not something we expected. We have the extent of and response to the current financial crisis. I read the Fortune magazine this week, the one that has about a 5-page article on Matt Simmons on it, which is very nice, predicting $500 oil, and but also has a nice cover story on how Hank Paulson saved the world because he bailed out Fannie and Freddie, and they said we still have to worry about Washington Mutual and Lehman Brothers. Didn't catch the AIG and Merrill Lynch and $700 billion of bailouts and all the rest of that stuff. And that's the issue that's on the newsstands now, dated a week from tomorrow. So there's a lot that's going on, and I can't keep up. I don't know what was going on Wednesday night, but apparently it scared the bejesus out of everybody in Washington, and they said, we don't know. There used to be a Constitution here, but Hank and Ben, you take it. And actually, what I think happened, and this is serious, the crisis of the last 2 weeks was all about peak oil. It was about peak oil because we have had, over the last few years, a very large trade deficit. The trade deficit has been largely driven by oil imports. In order to fund $2 billion a day of oil imports, we have to sell a lot of bonds to people. Now, the government doesn't run that big a deficit, hard though it is to believe, and so we had to come up with other securities to sell. The best ones that the foreigners liked were mortgage-backed securities because the government may or may not have endorsed them. We now find out that they did. We do. It's so nice of them to spend my money. But anyway, so we had to sell a lot of debt to raise the cash to pay for the oil. Therefore, we had to create a lot of debt so that we could sell it. And the problem was that the regular mortgage system wasn't creating debt fast enough. And so we had to come up with liar loans and ninja loans. Ninja is no income, job, or assets. We had to come up with, and one of the, Countrywide, I think, got a plan in which they took 12 seconds to approve a loan. And there was an interesting article, but basically this was driven by the demand for financing for our oil bill. And now we've finally learned out that, it does probably matter if people can afford to pay back some of these loans, particularly in an environment where the asset prices do not go up forever. And so we have completely redone on the fly our financial system in the past week or two and we're not done yet, to make up for the fact that we needed to raise money for peak oil. And I haven't seen anybody talk about this connection between the oil import problem and the subprime mortgage problem. But so there's lots of surprises and stories that they don't probably tell you and all of that. So when you're thinking about what kind of financial planning and investing to do for the future going out, don't lock yourself into one future. We have, through the oil drum and all these other things, marvelous charts. There are some of the most amazing charts on oil drum that I've ever seen. I mean, I can't follow them because there's only 41 lines on the chart. But, it purports to show exactly what's going to happen. And, one of them is sort of the peak oil export land catastrophe that's coming. But another one, in the last week or two, I've seen several stories that talk about a natural gas surplus. That U.S. natural gas production is starting to explode upward. We're already 8 to 10% over in 2008 over where we were last year. That the amount of shale gas that we have finally figured out how to get at is enormous. And that in fact, and we have and natural gas is something with compressed natural gas that may in fact be a petroleum substitute for transportation, at least for delivery trucks, buses, and certain uses of that. Now, I don't know yet. I mean, Julian wrote a book on the crisis of, the coming peak in natural gas several years ago. I'm hoping that someone here addresses whether this is a real opportunity or another false hope like ethanol. But, a month ago, the idea that we were not going to have a natural gas surplus, I mean, when gas has gone from, gas has fallen faster than oil in price in the last 3 months. So something's going on. I don't know what it is, and I don't know how real it is, and I suspect no one else does either. But if you had bet on peak oil and export land, you missed that one. It is possible, however remote and unlikely, that we will in fact have an intelligent response to some of this, that something like Al Gore's climate plan or Boone Pickens's climate plan, that we will get together and we will come up with a new way to make and distribute energy. And we will do it in a way that allocates appropriate amounts of capital, and we will have a nice smooth transition. This is, however implausible, it is possible that this could happen, even in America. As the world starts with export land to come up with real shortages, it is also possible that we could have another international conference in which we somehow come up with a less competitive way of allocating oil. The United States is not going to be able to get 25% of the world's oil anymore. And so as our share of a declining pool is also going to decline. So the United States can foresee less and less oil, not just less oil, because I think that our share is going to go down as the rest of the world decides that our 5% of the people don't get 1/4 of the world's allocation anymore. But can we do that in a peaceful way, or is it going to be a military or some other kind of competitive way? I don't know, but don't lock yourself into an investment philosophy that presupposes you can get that answer. And I think that another piece that I think occurred to me about Tuesday of this week is that the next president will preside over an event in his first term that is in the energy area that is as revolutionary as what we have seen in the finance area. That some crisis is going to happen that is going to lead to a massive changing of all the rules. I don't know, I mean, my personal guess is that within 5 years we will not allocate oil on the basis of price. That the international price of oil, we will not get to $500 oil. We will stop using dollars or any other currency to allocate oil at that point. because price is not the only way that you can allocate a scarce resource, and it is in many ways, not at all the best way. So we will have some kind of an energy crisis. It could be hurricane-driven, it could be war-driven, it could be, a lot of different things could start it. It could be a finance crisis, but somehow we're going to wake up and, Fortune magazine isn't going to talk about it on the issue on their newsstand because it's going to happen that fast. And what that looks like, I have no idea. But, if you're doing futures, 2009 futures make sense, 2012 futures, not so much. So when you try to look at all this, what I've done is come up with, as I mentioned last year, what I call Worldview 2. Worldview 2 is simply that the Worldview 1 is what you see most of the time and most of the advisors out there, which is basically the 20th century is still relevant. And the kind of things that we learned in the last 50 years will have some application to the next 50 years, and I don't think that's true anymore. So when you're looking at a world in which the US dollar is probably going to be less competitive, the energy resource and other resources are going to become scarcer, the consumption society is going to be reduced, you end up with a portfolio that is less in sort of traditional common stocks, more in cash and bonds, and the bonds are foreign bonds and they're tips and they're things of that nature, more in the commodities and natural resource funds. And so I've developed this portfolio and I track it monthly. And I was very brilliant, if you had asked me this about June 27th, because the natural resource part of this, I've got 25% of it in a natural resource thing that's got a bunch of these different mutual funds in it, which I'm not allowed to tell you which ones they are because we have rules against that sort of thing. So, but anyway, trust me, some natural resource funds and some of these alternative energy investments and so on. And for the year ending June 27th, the portfolio was up that part of the portfolio was up over 25%, up 13% in the previous 3 months. When you add in the rest of the foreign bonds and that kind of thing, it was up 14% in a year and a little over 3% in 3 months, which, considering that the rest of the, sort of the traditional portfolio was down, I felt very smart. We redid the numbers right before I left, which is probably not a good thing to have done. The one-year number on the natural resource portfolio has gone from 25% to 16% down. Now, 9 of the 12 months were in both units. So we lost 3 months in the last part of 2007. We picked up 3 months this year and went from a plus 25 to a minus 16. That's because in the last 3 months, this part of the portfolio went down 30%. Now, the fundamentals, peak oil is still there. We haven't found any substitutes for coal. We haven't found anything that's, changed the U.S. balance of payments. And what was up 13% is now down 30%. The overall portfolio is down 13% in a quarter. So fortunately, I don't give any of my clients my phone number. And, but I would leave you with well, one of the first things when I got into the financial planning world was the 5-100 rule, which is that any number projected 5 years in the future is 100% nonsense. And I think that if you remember that sort of thing, and as you're allocating not only your financial portfolio, but sort of your life portfolio, where you live and what kinds of careers you pursue and how often you visit your kids and all of those sorts of things, keep the resiliency there, keep the flexibility there, and be ready to be surprised more than you could have imagined. Thank you.
Thank you, Dick. If we rolled back the clock to June and oil was back in the 140s and your portfolios were up, if you had looked at the year-to-date gains and losses of some of the more well-known names like ExxonMobil and Shell and Chevron and ConocoPhillips, you'd be surprised to say we're in a peak oil environment maybe with oil approaching $150, yet these companies were lower year-to-date. So there was always this disconnect. So what the takeaway from that for me is that you have to be very selective on what you invest in in this environment. It was easy at the beginning of the cycle when you pretty much could own anything and it went up. But even the plumbers that were day trading and the electricians that were day trading in 99 and 2000, because all you had to do was buy Intel and it went up, they learned their lesson when that rolled over and never came back. And we have to learn the lesson as well that just because it's got oil in its name or its business doesn't necessarily mean you're going to make money with it. And let's face it, as investors, your job is to make money, not to invest for reasons that are for fun. When the market goes down, it's not so fun. So we're going to take questions for the rest of the time. And there's microphones, well, one microphone over there. So I'd ask you to keep your questions brief and to direct it to one particular gentleman. And because of constraints with the camera, the answer, if we're going to get it recorded for posterity, we have to respond to the questions here at the microphone. So if we have questions, I'd like people to go to the microphone and begin that process. And again, we didn't cover a whole lot of specificity in terms of what these folks are looking at in terms of their investments. And I'm not certain whether we can get to that point with some of these people who are constrained by rules and regulations. But there's a wide variety of investment opportunities in the spectrum of energy, from the international oil companies to the drillers to the infrastructure to the deep water people to all the ancillary businesses that are involved in the industry. And there's opportunities throughout if you know where to look and you do your homework. So please.
My question is for Jim Puplava. Given what we've seen in the last few weeks with the heavy hand of the government in terms of its refusal to let certain industries fail, should we throw fundamentals out the window, and should I short oil and go long financials? And it's a serious question. Or do you think that the fundamentals ultimately will rule?
Okay, the question is, with the heavy hand, or I call the invisible hand in the market, should you change your investment strategy? The answer is no, because fundamentals will always play out. Markets will always play out. The price of gold is approaching nearly $900. It's not at $250. The price of oil is back over $100. It's not at $20. And it was interesting because I got a call from a client, called the office. We don't give out the home number. Good advice. And he goes, "Why aren't we selling our oil? It's going to $75 a barrel. We've hit the bottom in financials. Why aren't we buying financials?" And I had to explain, when everybody's jumping out the window or going off the cliff, you might not want to get in line. You might want to just hold back a little bit, because these things do bounce back. And anytime you get a parabolic move in the markets, as we saw with oil when it hit 147, or when you saw in March gold hit 137, we know that there's going to be a pullback. It's going to come out. And we send out electronic communication to our clients every Friday. I saw this in 2005 after Katrina and Rita hit. In the month of September, I was a walking genius, because gold went up, oil went up, all the portfolios went up, and then the following month, we gave back almost a third of it. And so that's why you have to take a long-term view, because if you take a look at what happened in July, what happened in August, I don't think anybody here on this panel could have sat there and said, this is where it's going. We thought we would see a 15 to 20% correction. It turned out to be much greater than that. But we also said, why do I want to sell oil or companies involved in the energy space when I think oil's going to 200, 300, 400, or 500, whatever that number is going to be? And I don't think anybody can really define that number. So I think when investing, you know, when you see guys like Warren Buffett, and Warren's been buying energy companies this last week, or you're investing in railroad, these are long-term trends that we are transitioning to. The only problem that you have today is because there are, well, probably not as many as there used to be, But we used to have 9,000 hedge funds. You've got 9,000 or so mutual funds, and you have a heck of amount of leverage. When you have hedge funds, they're leveraged 30 to 1, 20 to 1, and you're that leveraged a 5% movement in a market, you were wiped out. That's it. You're out of business. So if you take that long-term approach, focus on fundamentals, and are not leveraged, you can afford to ride these out. Jim had a great graph on these market corrections in oil over this period of time. Yes, there were those 30% nosedives that we've seen, and anybody that has to go through that, I call it Mr. Toad's Wild Ride. Have you ever been to Disneyland? That's what we've been going in the market, and there are going to be many more of those. I hate to tell you. Who knows? We could get another one next week. But fundamentals will always play out in the long run. Thank you.
I'm not sure who to address this question to, but I'm wondering about the effect of the credit crisis on global oil demand, and specifically China and India and emerging markets.
To 2 decimal points now.
Yeah, get to my accuracy will be to just 1 decimal place. I didn't bring with me a graph in hindsight that I wish I had. I had put it in my report a couple of weeks ago. It showed the price of gasoline and consumption in the U.S. for the last 40 years. And it's interesting that fuel prices have preceded, the fuel consumption in the U.S. has preceded every recession in those 40-year period. If you had used that as a predictor, you'd have been right on the numbers. And in fact, if you go back to early 2007, U.S. consumption started to fall for gasoline before anybody was talking about recession issues. The fall in gas and oil prices here and gasoline consumption this time around is tied, I believe, to the recession. It has nothing to do with price. I don't think we hit a point where there was some price pressure, but it was not the major contributor, and that's would be my opinion there. The other, and while I'm on that point, back in the late 70s, the people who are talking about oil prices going down dramatically always bring up the late 70s and early 80s, when oil consumption in the United States and the industrialized world in general declined dramatically. But as I indicated a year ago in Houston, I think that we all got a major head fake there, and if we look at that as a model going forward, we're going to make a big mistake. Because back at that time, you had roughly 20% of homes in the United States heated by fuel oil, and about 20% of the electricity generated in the United States was generated by diesel. Well, going into 1979, we were beginning to build out our nuclear power fleet. And we had a very large surplus supply of natural gas available, which was being burnt off as a waste at that point. We moved dramatically to natural gas generation. At that point, it was cleaner. So you had the ecological implications there. So, and it was quick and easy to bring in to replace the diesel power generation. Currently, the only place you generate electricity in the United States with diesel and any consequence is a set of islands off the coast of the western United States. Hawaii accounts for essentially 100% of our diesel power generation. If you took it out of the count, we'd be at 0. Homes, now we're down to single digits in the U.S., and if it wasn't for states like Maine and New Hampshire, we'd probably again be near 0. The difference is that this time around, we don't have diesel to take out of electrical generation. We don't have nuclear to throw into the mix or a huge surplus of natural gas, but particularly the nuclear power plants are not going to come. Coal is going to be difficult to bring in, but they only apply to power generation. We have a transportation liquid fuel problem. So I think that the recession is the reason we've seen a decline in demand, and the only reason we're seeing a downward price pressure. And so I would look at that rather than pricing as an indicator. And I guess I maybe sort of answered your question, but I don't think that I don't think that the issue is going to be the banking in the sense, or excuse me, is going to be the banking related. If we don't get the recession pressures and the economic issues resolved, then oil demand probably will continue to decline.
I'm a PhD student who studies energy for my living with very little income, for those of you that have ever been in graduate school. And I have a small amount of money that is in a Vanguard account right now. And I guess I know absolutely nothing about the financial world except from what I hear about through energy.
And my question is, how widespread is the lack of knowledge about peak oil? And should I be concerned about my mutual funds in the future that have a very small amount of money, but again, with my income, it's a large percentage of that, I guess, that I have stored in this. Should I be worried? I mean, should I yank it and play with it myself, thinking that I actually might know more about the long-term implications of peak oil in the financial markets than people that are managing this money?
The narrow answer is that I've found very few people in the money management field or in the financial field generally who take the peak everything problem seriously, or who have, I mean, I haven't found a peak energy mutual fund. I mean, there are funds that you can use, but they're not driven by people who are really focused on this. The broader question I would ask, and, ask everybody in terms of, when you're thinking about this sort of thing, is what is that money for? If that money is for your, next apartment after you get your PhD, if that's money that you're going to use in the next 2 or 3 years, it is not play money. And, I get moderately crazy when I hear people talking about playing with, should I play in the stock market and that sort of thing. Well, if you have enough money that, I have clients who I say, okay, you've got 10% of your portfolio that you want to run, okay, that's your fund, and, I'll just sort of let you lose it or do whatever you want with it. But if this is something that is real money that you have an objective for, then take it seriously. There are a lot of good balanced funds. If it's short-term money, it ought to be in a money market fund, which at least until Wednesday was pretty safe, and I guess now is going to be safe again, now that we've decided to guarantee that too. It's sort of interesting. We have a $100,000 guarantee at the banks, but apparently an unlimited guarantee at the money market funds. But if this is something that is, so you sound like, okay, I don't have very much money, and I have this little bit of money that I really probably need to rely on because I don't know when my next job is. That is not play money. And it ought to be, at risk of getting a zero rate of return may be the best thing you can do in the next 12 months. I have no assurance. I always assume, that okay, the market's going to go down 40% in the next 12 months. I've always, for 23 years, been able to make a much better case that the market is overvalued on any given day than that is undervalued. And most of the time I'm wrong, but that's good. But that we're not through with this thing yet. And there's a lot of folks who think that we're in a massive short covering rally right now because we abolished short selling. And so all these guys have to cover their shorts. And so we get a 10 or 20% jump in the stock market. And then all of a sudden everybody looks around and says, wait a minute, the fundamentals aren't any better than they were a month ago. And everybody runs for the exit and we have a 40% drop. Possible, yes. Likely, I have no idea. But what does that do to your next job if you've lost half of your nest egg in playing the game? So if it's real money, sort of whatever portfolio you have, think about what the money is for first. Where does it fit in the rest of your financial life? And then, is it long-term money, short-term money? You can set aside 10% that if it goes away, it won't matter. Or if it triples, it'll be wonderful. And that, start with that question first, and then go to the, how you want to invest it.
I have one thing to say on that question, and if you said you were in Vanguard? Yeah. Okay. My recommendation, until we get some assurances of where this boat's going, is perhaps looking at Vanguard's government securities money market fund, because at least it's a money market fund that is holding U.S. government securities that aren't going to go away. Your yield won't be as high, but I think we have to worry about safety at this point, so you might want to consider something like that. Next question.
Yes.
Yeah, direct treasury, but I don't think it's enough money.
I'd like to direct this question to anyone at the panel. As peak oil comes to fruition, and certain industries just will not be able to tolerate higher and higher priced oil, and the government's forced to triage and determine who to save. I have noticed that no one has any confidence in aerospace or airlines. Do you foresee them basically taking over the defense sector
of the aerospace industry and just preserving it, even though it would no longer be a profitable industry, saying that it's merely required for this, for national interest. Being essentially, as the Russians or the Europeans have, where they're just essentially state enterprises where people, private institutions can't own stock.
Okay, I'm the military expert. You know, it was interesting, the Pentagon has been working on peak oil. Because have you ever been out on a Navy ship? I've had the privilege of being both on subs, carriers, and destroyers. In those destroyers, like you take an Aegis class destroyer, will go through 600,000 gallons of diesel in a week and a half. And so they're already looking at shale oil and other alternatives, because the military, as you know, we run a modern mechanized military today. We have ships, we have planes, we have land forces, and I think that you're going to see some kind of priority given to the military, just in case we go to the last man standing routine, where they will keep some semblance. One of the things that I think that you're going to see is we're going to use nanotechnology, we're going to use wars will be fought differently. You're not going to see, it was a couple of weeks ago, I was watching the movie Patriot, when you saw them, they all line up across the field and they point at each other. That's not the way battlefields or battles are going to be fought. It's going to be smaller, more localized, and so a lot of these big things that we have, like aircraft carrier battle groups, that cost, billions and billions of dollars, I think you're going to see that go by the wayside, because today we're developing the weapons technology, and even in the area of aerospace, pilots today have to fly at higher levels. You can't fly at 10,000 feet when the missile technology is as good as it is today. But there will be priorities given to the military. I don't know if it'll be supporting Boeing for research, so we're still producing some planes. I think also a new industry I think you're going to see, there's a couple people in Florida that are already starting out, and this goes on to the peace side of things, is you're going to see microjets and micro airlines. You might see something like the Honda jet for 1.8 million that has 7 people, and maybe it'll be able to get you from San Diego to Sacramento. But I think some priority for military, and I think it's going to be with nanotechnology. I heard that we're working on things like rail guns and other technology that we don't even know today, but no nation is going to let its military go by the wayside, and especially when today there's so many things that we need, and who knows whether it's going to be Richard Heimberg's scenario.
Thank you. I'm an Air Force pilot, so this kind of interests me.
As Craig Wishner with Post-Peak Advisors. I'll pick on you, Mr. Vodra, because I liked your 5-100 quote. So the question is, let's say that it's your own personal pool of capital, and you have a 5-year time horizon, and you want to put it in there, and you're going to be looking for total return. Where do you put your capital today?
As I said, I have what I call my Worldview 2 portfolio, which is about 20% in cash, half U.S. cash, half non-U.S. cash, 20% in bonds, half tips, half non-U.S. bonds, or primarily non-U.S. bonds, about 25% in traditional common stock mutual fund things, about 5% real estate, and then maybe in 30% in commodities and natural resource funds and ownership, direct ownership. So that's the general allocation that I use and have for a while, and sometimes it's better than others. So, but it's very much of a, it is built around the, what I call Worldview 2. It's built around the way that I think the world is working, but it's not, it has hopefully the flexibility so that, it's got some resiliency in it without, but if they change all the rules like they did in the finance world this week, I don't know what's going to work.
I'm just wondering, with all the,
Excuse me, sir, we can't have any harassment here.
harassment,
That's Jim Kunstler.
You're joking, right? Okay. Well, I hope this doesn't sound like a dumb question, but with all the really unprecedented turmoil in the American system, why should we really have that much confidence in U.S. Treasuries? I'm a little perplexed about why everybody is assuming that U.S. Treasuries are automatically safe.
There was a monthly newsletter written in June by Bill Gross, and there was an interview in Barron's with his co-investment strategist, a gentleman by the name of Mohammed El-Arian. And Gross is the head investment strategist for PIMCO, the largest manager of bonds in the world. And to me, that interview in his book, it's called When Markets Collide. Now, what I found, that to me was a very turning point in the market that nobody really picked up on. And in the interview in Barron's, El-Arian laid out an investment strategy for looking over the next decade. What I find was interesting is they had about 45% in stocks, 15% in the U.S., 15% in developed economies like Europe and Japan, and 15% in emerging markets. Now, here's the interesting part that addresses your question. Here's the largest bond fund manager in the world, and only 14% of the portfolio was in bonds. 9% in traditional type bonds and about 5% in tips. And I'm saying, these guys own nearly $1 trillion in bonds. The rest was commodities, natural resources, real estate, and I think they were talking about global. And one of the trends that they talked about that was going to happen over the next 10 years, and one of the reasons they were adjusting their portfolio, was the rise in return of inflation. So, you know, I think one of the reasons as a bond fund manager they might go with tips, even though I don't think anybody believes the CPI rate, which tips are adjusted by, but at least if we're going to 6% inflation, others think higher, that's going to go, at least you have something that will go up. But when the largest bond fund manager is telling you they're only going to have about 14% in bonds, what does that tell you? It tells you that they think interest rates are going up, which I believe. They also think inflation rates are going higher, and at the rate that printing presses, here's an investment idea, invest in trees and chainsaws, because they're going to be chopping down every tree in the forest. So I think that when somebody like that, or somebody like a Warren Buffett, starts changing and looking in this direction, look what Buffett's buying today. He's buying a lot in energy. He's investing in railroads. I think Buffett, understands the peak oil concept, that things are changing here. But I would definitely have some hedges in a portfolio. And a lot of people sometimes will look at something, and here's something I want everybody to be aware of. When you have a world that's as leveraged as it is today, when you have currencies in the world that are not backed by anything, there is no limitation since 1971 on in terms of what you can print, what you can manufacture. And if you listen to the press conferences or the weekend huddles, let me tell you, you want to own a lot of timberland, because the printing presses, get ready for the helicopter runs, or I would say not just helicopter runs, B-52 bomb drops. So, thank you.
Great panel, by the way. This question also is for any panelist that can address it. I was wondering what, if any, peak oil impacts we should look for on health sector investments.
I've actually had some conversations with the folks that connected with the University of Washington's Health or Medical Center on that. We've regionalized most of our healthcare systems very much, concentrating them in large industrial health centers. And that is going to come back to bite us And again, we've committed huge amounts of, in some cases, government capital to these public facilities to be built. So that one place I would pay real attention is if you got a bond that's backing one of those, it might be an issue you might want to address. But we're going to have to spend tax dollars to readjust at least that portion of the health system that's public, because it's not going to work flying people to these hospital regional centers with helicopters all the time. I was down picking my wife up from work the other day, and they had to hurry and get one helicopter out of there off the pad because another one was coming in right away. And these were just standard transfers coming in. They used to be that was a once-in-a-while event, but it's now becoming quite chronic. So we've made some major mistakes in that direction. From an investment standpoint, another example is the Harborview Medical Center, which is a big regional trauma center in Seattle, depends upon a regional materials distribution center, which is south of Seattle. And you may have heard of, we have this large pile of rocks just south of Seattle called Mount Rainier. And it's at 14,000 feet. And there are boulders where the, what if you guys were from Seattle? Rainier Brewery, which was one of our, it's where it was a big deal in Seattle at one time. We actually had a real brewery there. And there's rocks underneath that, and this is right near the bay, the main Elliott Bay in Seattle, that came from Mount Rainier during one of these eruptions, came down. But right in the path of where this would come happens to sit the regional distribution center for the medical supply company. And so since Harborview receives a 18-wheeler a night of supplies in real time, just-in-time inventory management, it's kind of Jim's Walmart on wheels applied to hospitals. It's not going to work. So a company that's structured that way is going to have to go through a major problem. I'm more concerned about the impact socially and personally and that than I'm actually about the money that might be in that arena. So I don't own any healthcare. I also have some other opinions about healthcare in general. But I think it's a very important topic. And it's probably one of those ones that has to be addressed on a policy level at the local level and that. But you can imagine in Seattle, if we had an eruption of Mount Rainier, takes out that distribution center, our hospitals are out of business. Okay.
This is to the two Jims. If the demand for oil only contracts during a recession, and we know from the export land model that going forward, the supply is going to contract, then doesn't the price of oil have to rise high enough to cause a recession, which goes against the exact opposite of what we've been told, that the price is declining because we're in a recession? And Jim Hansen, I know during the last ASPO, you had a graph showing that oil demand is becoming more resilient over the last couple recessions.
And I addressed that in Houston, and I apologize for not following up with that, because my point is that the demand is not as elastic as the investment community believes. It's becoming less and less. In the 1990 recession, which was pretty severe, we had a 30% decline in the markets in '89 because of the S&L and some other things that rolled over in the first Gulf War. You had a 30% pull down in the market, and we had a very minor blip in demand contraction of gasoline consumption. And if you look at every recession in the last 40 years, the decline in consumption has been compressing. We just now slipped below the 5-year moving average for gasoline consumption in the United States this month on that graph. And so we are not as elastic on demand as we think, because Department of Transportation put out a study that showed about 15% of U.S. automobile miles are in a category marked other. Now, what's significant about that is the other 4 categories included things like driving to work, shopping, family and recreational activities, and all of the social and family activities. Well, you add all those up, what's left? What goes into other? Well, that should be fairly elastic, and it probably will come out, but more than likely it comes out of the lowest income brackets. And those are not going to be high volume users to a large degree. So my sense going forward is that we won't see, well, we're down about 3% year over year. And we're just barely below the 5-year moving average of consumption. And we're in what I would say is a fairly steep economic downturn. Now, it could get, if it gets worse, if that trend line continues, then I would say that the situation is far worse economically than maybe we believe. But am I answering? Basically, I'm saying that, yeah, I agree. The gap or the decline in consumption has been compressing as we have moved more and more away from those substitutes have taken more and more out of our diesel and gas and fuel use. And we've become 95% transportation based. So, yeah, I do this one.
I think what I heard you saying is that there's going to be a growing gap between how much oil we would like to use and how much oil we will have available to us. And with export land, you know, that line's going down, the demand line is flat or rising, and worldwide that's true as well. Am I hearing you correctly?
The only way demand can be reduced is the price has to keep
No.
going higher and higher.
No. There are three ways that demand can be reduced. In Nashville, this week, they ran out of gasoline. Every gas station in town, there was a panic. There was a radio report that said, hey, we're running out of gasoline. In an hour, it was true. And every gas station in town was empty. So we have one way of allocating, which is by inconvenience. It is by mile-long lines. It is something that favors the poor because they don't lose as much sitting in a gas line as somebody who's rich. So inconvenience is one way of rationing. Rationing is another way of rationing. You get a card. It says 10 gallons a week. Next month, it's 9 gallons a week. It's however many gallons we have, and you can sell the stuff that you don't want to somebody else who wants it more, and that way you get some of the scarcity rent instead of it all going to Exxon. Or you can just run the gas price up to $12 a gallon or as high as you have to go until people stop driving. So there's lots of ways to cut demand. And you know, free market, you know, we ought to try that sometime, but we haven't yet. But there's lots of ways that we can do, we can reduce demand besides just raising the price. And I think that given the social constraints on, for one thing, the question about health care, at $12 gasoline, the nurses don't make it to the hospital, and the orderlies don't make it to the hospital, and the maintenance staff doesn't make it to the hospital, and the teachers don't make it to schools, and the economy stops. So, you know, we've got to make it work for everybody. We've got to have a way that everybody gets to work, and that's not $8 gasoline. So we will come up with another answer. I don't know what it is. This may be my weekend crisis that I was talking about earlier, but we have to solve the demand problem simply because we can't use more gasoline or oil or jet fuel than there is. We will solve that problem somehow, but it doesn't have to be by higher prices. Higher prices will probably be an element of it, but not the whole answer. And I think we're about done.
Yeah, having worked in a gas station when I was 18 back in '73 during the Arab oil embargo, I was the guy that actually pumped gas and wiped your windows and checked under the hood. And it was 35.5 cents a gallon. It went to 50, and it was my fault. Everybody got it, and I
was wondering who did that.
Yeah, believe me. But then they started rationing, and then it wasn't just that it was 50 cents a gallon. There was rationing, and you couldn't buy today because your license plate wasn't the right one. So, how much time do we have?
I think we're out.
Oh, we're out. Okay. I'm sorry we didn't get to all the questions. Thank you very much for attending. We appreciate your attention.